Hello, dedicated traders, and welcome back. You're watching a new market breakdown, and today our focus is on the pound sterling to Japanese yen currency pair, one of the most volatile and opportunity-rich pairs in the Forex market, driven by liquidity from both the Bank of England and the Bank of Japan. Let's begin on the 15-minute time frame, where we conduct our intraday structure analysis. Since Thursday, the pair has been forming a bearish market structure. We've seen a consistent formation of lower highs and lower lows, a classic sign of trend continuation, indicating that momentum is still controlled by sellers. Now, if we map the main impulse wave using Fibonacci, we can clearly observe that prices were traced into the 0.382 zone, which is considered a healthy correction level within trending markets. This is where institutional participants often step back in to push the price toward trend continuation. Based on this position, the likelihood of a renewed drop is significantly strong. Just a little above our current price level, a robust resistance zone is also present, an area where price has previously reacted multiple times. This creates a psychological barrier for buyers and, at the same time, builds a fuel zone for sellers. With this context, the probability of price aggressively breaking above this region remains relatively low. As price currently trades near the upper boundary of the Bollinger Bands, we're also witnessing the beginning signs of downside pressure, which aligns with the structure we've been tracking. However, it is important to emphasize that high-probability setups are not formed by a single tool. We always need multiple confirmations. That's exactly why we now shift to the 1-hour time frame to analyze the bigger structure. On H1, the bearish trend is even clearer. The price is respecting a descending trend line, which shows disciplined selling behavior, not random or emotional movement. This tells us that the market is trending, not ranging, and more importantly, the current pullback is likely just a temporary correction within the larger downtrend. The RSI indicator on the 1-hour chart is also confirming our directional bias by holding below the middle 50 level and showing a slope toward bearish momentum. This strengthens our view that the market is still in a sell-dominant cycle rather than shifting into a reversal to the upside. But to identify the exact trade levels, we will now return to the 15-minute time frame. And here is the key part. For entering the trade, we go back to M15. In the chart, I've marked an elliptical area, a decision zone where price is most likely to complete its correction and resume the downtrend. Inside this ellipse, I've also highlighted your potential entry and exit boundaries to guide you visually. These zones represent a trade window, not just a prediction, areas where confirmation could offer a strong sell opportunity toward the lower support level. At the end of this video, you can check the exact time this analysis was published.